Everyone, welcome to today's video in regards to the upcoming decision by the US Central Bank, which is on June 14th. I am your host, Nikos Zabouras, Senior Market Specialist at FXCM, and just to timestamp this video, it is recorded quite a few days ahead of the Fed decision. It is recorded on Friday, June 9th. So the US Central Bank announces, as we said, its decision on Wednesday, June 14th, at a period when there is great uncertainty around the monetary policy outlook, not only by the Fed, but other central banks as well. We have seen some difference amongst Fed officials, as they have already delivered a massive amount of hikes, but inflation remains far from target and the labor market is still tight. Furthermore, the recent banking turmoil has added another layer of uncertainty. We will be discussing about all of that in today's session, but as always, before we do, please read carefully through the risk warning and the disclaimers, and then we will begin. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed does not constitute investment advice and should not be construed as such. Okay, let's get the ball rolling. The main options for the Fed appear to be between a hike or a hold, and in today's video we will talk about that and some of the reasons that support its move and what else to look out for. We will start with the case for a hold, and the first reason we have highlighted here is the cumulative rate increases, as the central bank has already delivered 400 basis worth of hikes in 10 consecutive meetings since the March 2022 liftoff, a little over a year. This is a massive amount of tightening in a small period of time, in the most aggressive cycle in decades, which has brought rates to 5.25% and the highest since 2007. This level is also in line with where Fed officials expected rates to peak, as the projection for the median rate was at 5.1%. Of course, the reason why they're hiking is to bring inflation down. Now, monetary policy works with long and variable lags, as many officials have indicated multiple times. It has a lagging nature. It means that their actions need time to actually make an impact. And Chair Powell, in his press conference back in early May, had talked about such lags and said that it will take time for the full effects of monetary policy to be realized, especially on inflation. More recently, Mr. Jefferson, who is a voter, had noted that monetary policy works with long and variable lags, and that a year is not a long enough period for demand to feel the full effect of higher interest rates. So policymakers don't know exactly when to stop hiking, but they feel they may have done enough and that they are at or near the peak. They don't know yet if their stance is successfully restrictive, though, to bring inflation back to the 2% target. And Chair Powell had alluded to that back in early May, as he was specifically asked and said that he cannot determine that, and that is an ongoing assessment. And the third reason for a hold would be credit tightening. The recent banking turmoil that started with the collapse of Silicon Valley Bank threw a curveball to the Fed, adding another layer of unpredictability. And although policymakers have said that it is hard to estimate the extent of its impact, they believe that the relevant financial stress will weigh on economic activity, on hiring and inflation, doing essentially some of the Fed's work for it. And as a matter of fact, Fed staff expects a mild recession this year because of that financial stress. Now, even though Chair Powell does not see recession as the main case, as the most likely case, he said again in May that tightening of credit conditions is equal to one or more rate increases. Essentially, what he says is that the Fed may not increase rate as much as if that turmoil had not occurred. Now let's go to the other side of this coin, and let's see why the Fed may need to hike. The first is high inflation, which, yes, has been moderating, but core measures, which exclude food and energy prices, have been particularly sticky over recent months. The latest PCE report showed an uptick in core to 7% year over year in April, while headline also rose to 4.4%. This is important since it has been easing since the June 2022 multi-decade peak, and April's print marked the first increase since then. That's a worrying sign, and in any case, inflation is far from, be it PCE or CPI, is far from the Fed's target, 2% target. Now, the other side of the Fed's mandate is strong, is the labor market. And in the May press conference, Mr. Powell had spoken of an extraordinarily tight labor market of so much excess demand. Job gains picked up pace in May, according to the last jobs report. Unemployment increased, but is still close to its 5-decade lows, and wages remain elevated, even though they ticked down slightly. And this labor market does not make it easy for the Fed to stop. Now, we talked about how credit tightening is a reason for a hold, since the Fed expects it to be equal to a hike or more. However, it does not seem to be that significant so far, and is mostly a result of the monetary constraint, not so much of the banking turmoil. And various officials have alluded to that. For example, Kansas City Fed published a report in late May that arguing that historical evidence suggests that financial stress may be less effective in reducing inflation compared to monetary tightening. Mr. Jefferson, who is a voter, said that the evidence so far show only a modest incremental tightening of lending conditions, and the International Monetary Fund said that the bank failures had only a modest effect on credit conditions. So, yes, we have seen credit conditions tightening, but not significantly, potentially, according to such commentary, and to the extent that they have happened, it's mostly because of the Fed's monetary constraint. So there are definitely reasons for both a hike and a hold. And now let's see what to expect now ahead of the Wednesday, June 14 decision. Other than the decision on the rates itself, the press conference and the vote count and the updated projections will be in focus. There have been different opinions amongst policymakers, and we will talk about it in a bit. And although officials will likely want to come out and try to come out with a united front, it remains to be seen if they can achieve that. Now, part of the projections that we talked about, the updated projections, is also about the appropriate policy path. Median terminal rate was projected at 5.1% the previous time, and that's in line with where actual rates are now at 5.25%, but the minority saw them higher than that, even as high as 5.9%. So for 5.9%. So now we want to see how these projections evolve. What do officials believe of the appropriate policy path? And I think there are good chances for an upgrade there. Now, we have recently seen divisions amongst officials in speeches and in the minutes of the previous, of the last meeting. Back then, several participants noted that further tightening may not be necessary past that meeting, but some participants thought that more hikes may be warranted at future meetings. The latest Fed speak right before the communication blackout period started were a bit on the dovish side. Mr. Harker and Mr. Jefferson, both voters, called for a skip in this meeting, but kept more hikes in play after that. Other officials had been more hawkish earlier on. Miss Logan, for example, does not believe it is appropriate to skip a hike. And in any case, either the less hawkish or the most hawkish commentary, I'm not sure if you can say dovish, point to the need for sustained restrictive stance. So they don't talk about the terminal rate, they talk about skipping, pausing. So what do markets expect? Market expectations have been going back and forth and have been quite volatile, but adjusted to that latest commentary, and CME's Fed Watch tool assigns at the time of recording the highest probability to rates staying at 5.25% at this meeting, but still prices in another hike after that. So overall, a hold seems reasonable because of the amount of tightening the Fed has already delivered and the lagging nature that we talked about. But on the other hand, the labor market is still very tight and inflation is far from target. So even if policymakers stay on the sideline, they're more likely to not speak of a terminal rate and actually to keep the door open to more hikes in the future, and also tout their data dependency. But again, they're more likely, based on what we have seen so far, to emphasize that this is not the end, even if they do stay on the sidelines. A pause here is priced in by markets, so if this is the outcome, we will need to see what else we get from the Fed in terms of forward guidance and the dot plot. So that's potentially pivotal decision, as the Fed, there are good chances for the Fed to actually pause a year-long tightening cycle, more than a year, but monetary outlook is uncertain at this stage. And again, this is evident from what other central banks have done recently. So that's it from me. Thank you for joining me.